Good day, all. Ira Epstein of Linn Associates with your agriculture wrap-up for this Wednesday, the 17th of July, 2019, and we're about 4:47 p.m. Central Daylight Time. I'm going to start off by telling you, number one, the market boards have already cleared behind me. That's why I've got the chart starting this off. Number two, I'm taking a day off tomorrow. So do not look for your end of the day video on Thursday. I'll be back for the weekend edition, and I'll be telling you I am going to take a few days for myself in a small, very short vacation. But I've got to lead up to it, and in order to do that, that's how I work. For my subscribers, when I'm going to my research, especially the morning video, I fully intend on putting those out when I'm on vacation. They may not come out at my 6 a.m. because I'm going out west. We'll see what time I decide to put them out, but they'll be there, and they'll be there for you in the right type of manner. So where are we in these markets? Well, we're in a pullback. The market had its big up move. We're in the growing season now. So the question now isn't one of getting the plants in. The question now is, how are those plants doing? So each week we see typically around Monday or Tuesday, crop reports come out, and they'll give you an idea of how the crop progress is going. Then you've got to be watching the weather. Is it too hot, too cold? Where are you? That's the phase that you get into when you're sitting here at July 17th. By August 12th, we know a lot more about this crop. This year is unusual. There were rumors circulating today that the government as early as tomorrow is going to give us new numbers on corn. They're doing a survey. They just told us that. Why would the USDA pop a number all of a sudden? I think they're going to wait, release it when they said they will in August, and we'll decide at that point what that means. So right now, you're down 24 cents in beans. This is not atypical. This is the heart of the growing season. As you can see on the daily chart, we're in the midst of a pullback. And you never did fill this gap. And no, I'm not saying you have to, but there is a gap there, and it's good to keep in the back of your mind. We're now pulling into lower support as measured by this area right here. The pattern on the chart is not a trend. You have a pattern of a lower low, and then this rally took out that high, so we're void of a trend right now. That puts us into moving averages. So I'm looking to see where the averages are. Now, yesterday, the market was able to close under a combination of the 100-day and the 18. That was a sign that either you pop back into them today or you're going to go a little bit lower, and that's what you did. You did both. You popped back in, as you can see, tried to make it to the 18, and when you didn't and took out yesterday's low, you followed through to the downside a bit. You didn't crash, it's a follow-through. More or less, if you look at the Bollinger Bands, you got pretty much a broad sideways range that is wide. I would be surprised if it doesn't try to narrow in here. So on a rally, I'm still going to look for resistance at the 100-day and the 18-day average. If you break hard to the 890 level, it's 10 cents away. It's not as hard as it sounds. I'd look for support at the Bollinger Band. We'll see what happens. Momentum still pointing down. So here's what we have. Downside bias, because whenever market closes under an 18-day average, that defines my bias. That means it's down. If it closes over it, the bias is up. That's how I look at it. I have downside bias, void of a trend, and momentum pointing down. In the soy meal, you've got to be careful that you don't get what's called a bearish crossover. That's where this 18-day average closes under the 18. If that happens and you were to break further because of that, well, you'll see 308.50 taken out. You put into play the lower Bollinger Band at 304.70. Is the market oversold? Yes. Any reading, by my definition, under 30 is oversold. So I have an oversold market. The market, I could argue, has a pattern of higher lows and higher highs. This arrow should actually be pointing up because that's how it ended at the end of the day. And I wouldn't be surprised if you break through the 308.50 that you make a run to the lower Bollinger Band. As I've said before, and I'll say it again, the market that's just like the tail of a dog. It's getting whipped around back and forth. It's the oil. it's not in demand at this point. It's the meal that you look at in beans. Lack of demand or good demand. But that's moving it, and that's why I don't see any follow-through one way or the other. Should it break down further, the lower Bollinger Band is a support zone. Resistance, the 18-day average. And again, no trend. You've got the higher high, lower low. In the corn market, how many days do you want to keep fighting at this 18-day average, what I call the line in the sand? The trend is still up. The market's fighting resistance now of that number. If you broke through the 435.5, you might get down to the 423.5 level. We'll find out. The trend is still up until you break through that 435.5 zone. If you do, you put into play the objective, doesn't mean it'll be hit, of the lower Bollinger Band. In the wheat market, it's like corn. The difference here is you're very oversold. You have a market with higher lows, higher highs, but the bias is down because you've been staying under the 18-day average of closes. In the sugar market, this is called riding the lower Bollinger Band. But the riding of it, today you were sharply under it. Yesterday's settlement was under the Bollinger Band, and the day before, 1206, was under. So you're 3 days in a row under it now. Be careful. Generally, 5's about the max you stay under a Bollinger Band before you get a correction. If you look, the market is oversold as can be. Can it embed here? Well, both numbers under 20, both under 20, but not the day before. It could tomorrow. I would think the odds favor it's going to fight at that Bollinger Band in some manner, but you can't get away from the fact. The market's in a bear move, and what you don't want taken out is today's high. It's an outside day down. If you take that out, especially on Thursday or Friday, I'll call that a bear trap. And when that occurs, often, not always, often, it means price is going to make a run at the closest of the main moving averages, which I'll define wherever that 18-day average is. That would be the number. Coffee, crazy market, just back and forth, whipping at that line in the sand, that 18-day average, looking for a trend it doesn't have right now. Just whipping back and forth. Cocoa made that run the other day to the lower Bollinger Band. It did not do it here. It did it here. That was Tuesday, and you're getting a bounce away from it today. Are we trending? No. You've got the lower and low, higher high pattern. Now in the cotton market, you're still very much in an ingrained, embedded downtrend. Lower highs, lower lows, as you can see, ran under the sugar, got under that Bollinger Band, popped to the right-hand side, and has resumed the trend with a fully embedded reading. Until that reading, this red line closed over 20, I wouldn't be surprised if you go and keep trying to get down to that lower band. In the cattle market, you lost today the bullish embedded reading. Now, if you don't get it back right away tomorrow, that often leads to price and the 18-day average trying to make a run at each other. The swing line is down. That's countered because the bias is up since you're over the 18-day average. But we've put into play the idea of that 18-day average may be returned to here. And the same thing is happening in the feeder cattle at the same time. So this up leg ended. Now the question is, how much downside is there in the market from my definition as to how these chart patterns are setting up? In the hog market, it's completely different. We had talked a while back that this market's looking better. It's amazing because China keeps coming out. Now they say they've only culled 27% of their sow herd or so. We're hearing numbers closer to 50%, and that's a major rebuild. The market's not buying what they're saying, and it's moving up. Does this mean there's a trade deal or that China's going to buy something? I can't answer. What's not surprising is it's barbecue season, and I don't know about you. I love ribs, and away you're going in the hog market. And as you can see, those charts behind me. You know, one of the things we do that you don't get in other places is our chart of the day. Now, let me explain. The chart of the day is not your trade of the day. The chart of the day, we're looking and scouring the market for a certain pattern in the marketplace. If it's got this pattern where you come down, back up, and start breaking, it's called a price count. You can get it to the upside and downside. And as they start showing up, you pay attention to them for one reason. They're giving you an idea where a market might go. That's all it's about. To get it, give us a call. We'll put you on our free mailing list. Go to our website, www.iraepstein.com. Sign up for it there. Take a look at them. We can take you off the list at any time. There's no obligation on your part. And we do have a video series that teaches you the importance of this, how to use the software we have to put it on your chart. Those that get hooked on it don't walk away from it. I have found a lot of people just say, wow, I really like that. But don't get me wrong, some people might think it's not for them, but people, once they understand it, it's sort of like a Fibonacci and a Gann all tied together with the swing line theory. I'm Ira Epstein. You have a good day. Remember, I'm not here tomorrow, but I'll see you Friday.